What's going on, everyone? I'm Mike with Penner Investments, and today I'm going to talk about the CPI data that came in hotter than expected on this past Thursday, October the 13th, and how I plan to profit from this. Be sure to hit the like button and subscribe to my channel so you do not miss out on future content as well, and thanks for that. The Consumer Price Index data measures inflation, and it came in at 8.2%, which was higher than the projected 8.1%. The Fed is trying to combat inflation aggressively, and their tool to accomplish this is to increase interest rates, which is bad for businesses in the stock market. The reason is because higher interest rates makes it more expensive for businesses to borrow money, and this cuts into their profits. Just like if you're trying to buy a house right now and the mortgage is more expensive, you got less money to spend. As I mentioned in my last video, the Fed is scheduled for a November the 1st to the 2nd meeting, which means the decision to raise interest rates will be released in this press conference following the meeting. This is typically somewhere around 2:30 p.m. on the last day of the meeting, so that'll be on November the 2nd. I see the Fed raising interest rates at a minimum of 3/4 of a point, which should send the market lower on this once this information is released. This is the same reaction that I said would happen to the market after the CPI data was released. On the opening bell for the market on Thursday, October 13th, the S&P dropped around 2.5%. I was expecting a little more as the CPI data was hotter than expected, but just as I said, I was going to buy a few SPY puts prior to this data being released. I wound up buying 3 contracts for around $3,032 with a strike price at $352 and an expiration November 25th. This was close to the 45 days to expiration. Shortly after the market opened, I gave it a few minutes to see the reaction to the CPI data. I did not see it moving quickly past the 2.5% drop, so I decided to go ahead and close out my positions. I sold the 3 contracts for just under $4,500, which resulted in about a $1,500 win or profit for that trade. That's a nice 49% return in a couple of days. Not too bad, right? Now what I'm going to be looking for is a nice update in the market over the next couple of weeks prior to the Fed's press release on November 2nd. As I mentioned before, put options are a little cheaper to buy on a day the stock market or the index of whatever option you're buying is up on that day. I'm going to be buying some SPY put contracts that are close to the 45 days to expiration. And I'm going to be looking to go somewhere around the 2.5% to 3% below whatever the current strike price is that day. For example, if the SPY is trading at $350 a share, I'll buy the 340 strike price puts. My goal here is to take advantage of the knee-jerk reaction the market will have to the interest rate increase. And I'm sure Jerome Powell, the chairman of the Fed, is going to be making some hawkish comments as the inflation hasn't been being reduced quite as they expected. When the news comes out and the market drops fast, I'm going to look to exit this strategy that day. As the market has continued to be choppy, as just this past Friday it pulled back 2.25%, which still would have been another opportunity to exit this trade if you had bought any of these puts prior to the CPI data being released. This is the reason why I always target 45 on the low side, 60 on the high side days to expiration when I'm buying a put or a call option. And this still gives me plenty of room to close the trade if it does not work out exactly as I'd hoped. I never put a whole lot of money in these directional trades, as you have to be right on the direction for the trade to be very profitable. I use these type of trades when there is a catalyst in the market or the stock, so that way the stock is going to make a big move, and then I have an educated guess on what direction the market is going to move. Well, I hope this information has been helpful, and good luck trading.